Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It is lecture time, and this week's topic, guys, is bias, as well as entry bias, higher time frame bias. So we're going to talk about seeing the forest from the trees today. All right, a lot of you guys are trading in a vacuum. You're trading so tunnel vision that you're not understanding what's going on around you. And sometimes what you'll see is the failure of a lower time setup will confirm the higher time frame setup. So what we're going to talk about today is we're going to take a look at a 2-minute chart and a 15-minute chart. We're going to see the failure of a 2-minute sell setup actually confirms the 15-minute buy setup. So it's a very important concept. It's not as long of a lecture. It's only about 30 or 35 minutes, which is a little bit shorter than my normal ones, but it's one of the most powerful lectures I've done in quite a while because it will save you guys from getting into lower time frame charts that you shouldn't be in the first place. The higher time frame will save you, but also it will help you take more accurate trades on the higher time frames as well. So it's a very powerful lecture. So it's not just a multiple time frame thing. It's understanding what's happening on a lower time frame versus what's happening on a higher time frame. And sometimes they're the same and sometimes they're different. And you need to understand what the difference is so that you don't take a bad trade on the lower time frame. All right. So if you like this video, guys, click that like button, hammer that subscribe button. I'm Jared Wesley of Live Traders. Let's get to it. This week's lecture topic is understanding the bias. And that's a little bit wrong, a little bit biased, so to speak. We're going to be talking about understanding the bias time frame as well as the entry time frame. We're going to be taking a look at both because it's something, this is kind of a continuation. We talked about multiple time frames a couple weeks ago, and then we talked about bottoming tails and confirmation bars, pivots and bounces and stuff of that nature. So today we're going to go and take a slightly broader look. There we were looking granularly inside each bar. Well, we're going to do that too. Okay, there's a couple slides where we're going to literally look at each bar. But we want to take a broader look to start, and then we will go deeper. So I want to be clear. We're going to start with a broader forest-based look, right? You guys understand that analogy. I use it frequently, right? A lot of traders, they're sitting on the bark, the branch, the leaves of a tree, but they're not understanding that the forest around them is on fire and closing in on them. That's the daily, that's the 60, that's the weekly, that's the higher time frame, that's the bias. And you're not understanding that if you get the bias wrong, the entry time frame doesn't matter. Write that down. If you get the bias time frame wrong, the entry time frame largely doesn't matter. Okay, you may get away with one here or there, but most of the time you won't. So make sure your bias is right because the rest won't matter if it's wrong. Okay. Good news for you guys is I'm taking a break. It's been a while. I think I can't remember actually how long it's been, but I'm taking a break this week from When Will the Insanity Stop? I do not have a When Will the Insanity Stop segment or version for you. So it is what it is. Let's dig in. All right. So we have spoken at length about multiple time frames. Okay, multiple time frame analysis, etc., and so forth. So you must decide what time frame you will trade in and which you will gain a long-term bias from. Okay, then apply trend, supply and demand, and bar-by-bar analysis to find trading opportunities in that time frame. All right, but the bias is put in red there because I want you to see it. Jump off the page at you so that you will understand that this is the most important thing you'll have. All right, I would much rather have a strong daily chart than a really pretty lower time frame pattern with no strong daily chart, if that makes sense. Okay, so I'll repeat that. I'd much rather have a really great daily chart where the lower time frame is not quite as clean than a really clean lower time frame with a terrible daily chart. That does nothing for us. Okay, so let's take a look at what it looks like to match something. Okay, some of these are more recent, some of them are a little bit older. This was from about, I don't know, a year ago or so. Anyway, take a look. If you go over to the daily chart, the left-hand side over here, you're looking at a stock that clearly was in a downtrend. We know this because you can see the declining 200 period moving average. I know it's in a downtrend. Okay. Over here, you can see on the daily, this is in a stage one. Look at the volume down here, right? One of the attributes of a stage one is narrow range with resting volume, right? Quiet volume. And that's exactly what you see here to the left. Over here, we get a wide range green bar, and it looks like it might put in a 3 or 4 bar play, and it doesn't. It pulls back, chops, pulls back, chops, and then this happens. Wide range green bar takes out these prior pivots, gives you a 3-day, 4-day consolidation, and then it moves higher. So this is the beauty of this. Not only are you getting a daily 4 or 5 bar play, whatever you want to call it, breakout, right? On that same day, look what's happening over here. So right here, take a look at those 3 bars. That's this 15-minute chart, that's this 15-minute chart, and that's this 15-minute chart. And then on day 4, boom, stock rips up, pulls back, and rips higher. So this is a great example of making sure you're starting with an awesome daily chart, a strong daily chart, and then drilling down and looking for a lower time frame entry. Now, this one's nice because it gives you choices. You can trade the daily, or you can wait and trade the intraday. Okay? And in professional trading strategies, we talk about intraday swing trades. This could have been one of those. So this is an example where, hear me out for a second, where you could have started the trade right here at $3.55, $3.60, right? Because that's the trigger. That is the daily chart trigger, and you would use the daily chart stop loss. So you could get in at $3.55 like it says. Stop loss is $3.30, 25 cents. Wonderful. But you're going to have more shares with a 25-cent stop loss than you are with a 5 or 10 cent. So when this stock pulls back, gives you a 15-minute buy setup at $3.65, and then a 5-minute stop loss. So you're like, I can definitely add some shares to this because now I'm double dipping. I started with a really wide stop, and I'm still interested in swing trading, but I'm going to add a bunch of shares at $3.65. Okay, cost average might be $3.62. By the time you're done, it'll be a little over half because you're going to add more than half, right? And all of a sudden, your stop loss becomes $3.60. But here's the rub: it's a nickel. The stock moves up like 30 cents, 6-1, right? 6-1. Now, for the daily chart trade to give you a 6-1, you need $1.50. You need this to go to $5. That's a big move. So in this case, a nice balance here would simply be buy it on the daily at $3.55, use the wide stop. Why? Because we don't know yet. We do not know if it will give us an intraday entry. So if it doesn't, at least we have the swing trade. If it does, we can mix and match and double dip. So in this case, it does. You buy way more shares, probably triple the shares, okay? Now you have like a $3.62 cost average, and your stop loss is like 3 cents. Hello, 3 cents. Rips up 30 cents. Technically, it's 10-1. But here's the awesome part. You sell maybe 75% of your shares because it's such a monstrous move, right? 7, 8, 9, 10 R. Sell 75% of your shares. Hold a quarter of the shares. Keep a little bit of a wider stop, right? Now you can afford to because you have much fewer shares, right? You don't have 3 times as many shares now. And you've already bagged out, 7R? Something like that, 6R. Give it a slightly wider stop now. I wouldn't give it $3.60 and hold some for a swing trade because you never know. It might go back to $5, right? It might go back to $5. So in this case, real quick, I've spent a long time on this slide. I'm going to move forward quickly. So 25-cent stop loss. Let's just say you bought 1,000 shares, $250 risk. Now let's say you add 2,000 more. So now you have 3,000 shares. Well, you have 3,000 shares, but your stop loss is only 3 cents. You've actually lowered your risk. You've actually lowered your risk, right? Because now your average cost is like $3.62. Your stop loss is $3.59. You have a $120 risk. This thing rips 30 cents with 3,000 shares. You're up $900, right? Something to that effect. Go ahead. Sell 2,000 shares. Sell 2,500 at a 30-cent profit, right? Now all of a sudden you've made $750 in the bag, and you have 500 shares or 1,000 shares for a bigger move, if that makes sense, okay? Now, here's another example. These don't happen as much, okay? And it's important to note that this, a lot of times when I say look for a similar picture on a higher and lower time frame, well, this is rare, okay? You're getting a daily 3-bar play with a 5-minute breakout and buy setup, as well as a 15-minute 3-bar play, okay? I don't know why this says entry 295. I think it means like 62.95 is what I think it means, okay? And I think it means 62.70, and I think I forgot. Now, that can't be right. It can't be 62. Let's make that, I don't know what that is. Let's just call it $57, all right? I really don't know what it is. I'm just guessing off the chart, okay? But anyway, the point simply here is you have a swing trade right here, and you have room back up to like 70. So in this case, you don't have a great risk to reward, but you can take the swing trade, look to add back, and in this case, that entry on the 15-minute 3-bar play is 63.65 with a stop loss at 62.25, so $1.40, right? Moves up, pulls back, moves up, and at the end of the day, you're at $66, give or take, okay? You can see it's actually over $66 here on the 5. So that's a $2.50 move, and there's about 2 to 1 there, okay? You can also add on this pullback if you chose the 5-minute. But this is another example of using the daily chart, drilling down to the lower time frame and finding an entry, right? Make your trading simple. Don't make it so hard on yourself. But what's happening to a lot of traders is for example, they'll build a gap list. That's fine. Good so far, right? And then someone in the chat room or someone online or on StockTwits or wherever will mention an idea like, hey, check out XYZ. And they'll look at the 5-minute and go, wow, that's a beautiful 5-minute chart. And they'll get in it, it'll stop out, and they'll send me an email, Jared, I took this beautiful trade on XYZ. Why did it stop? And then I'll look at the daily or the 60 and I'll be like, yeah, you're right at resistance. You're sitting at double top, triple top resistance. Of course it's going to fail. You're at the MA, you're at resistance. I had this problem my first 3 to 6 months of trading. I never looked at 60-minute charts. I don't know why. I just had a brain lock. And I was always drilled into my head, look at 60-minute charts, look at daily charts, and I just wouldn't do it. So the 60-minute chart, the daily chart is your friend. It really is. So as nice as this 5 is, this 5-minute, it's nothing without this daily 3-bar play, okay? So again, I don't want to spend too much time on this specific topic. I think you guys get the general gist, right? Start with your daily 60-minute bias. That bias should be clear and clean. If it's not, then it's not a good daily and it's not a good 60. This case, the bias is pretty clean. What is this stock doing on the daily? It's putting in a double, triple top retest. This is a stage 3. Right? It's a V-top stage 3 that retested and failed. Once this got under 200 and then once it got under 190, it was over. You're starting to put in lower highs and lower lows. There's a lower high here. There's a lower low here. There's an equal high here and a lower low here and a lower high here. You are now beginning the early stage 4 downtrend. You're in that stage 2 uptrend, stage 3 V-top, stage 4 downtrend. And yes, there are transition periods in here, right? So now that you know the daily is no longer as strong as it used to be, it's under the 50-period MA, it's putting in lower highs and lower lows, it's trending lower. Now you get a gap under the last bastion of support, this bottoming tail green bar. Your job, drill down. Find yourself a lower time frame entry. And in this case, it happens early in the day. It's a 5-minute, 3-bar play just above the 180 area, and this thing tanked. I mean, my goodness, it went like $12. And the stop loss looked like it was about $2, right? If I'm looking at that, it's about a $2 stop loss. It went about 6 to 1. Why is it possible? It's possible because there was a smooth move up on the daily, so there's no support to the left. And you're in an early stage 4 downtrend. Not an extended downtrend, an early downtrend. And they tend to move early on in the move. They tend to move more. Nice daily, nice lower time frame. You got to ask yourself, why don't we do this on every trade? You know what the answer to that is. It's a psychological answer that we manufacture trades, and we manufacture trades more frequently in times of duress, stress, or when the market is choppy and not giving us as much. So when you're on a losing streak, we tend to manufacture trades more frequently. When the market is choppy and we're frustrated because the last week or two or three, the gap list has been crap, you start to see things that aren't there. This is pretty straightforward, right? Every one of you guys right now that's looking at this is like, yeah, it's pretty simple. It's gapping under a bottoming tail. It's gapping under a green bar. It's gapping under a pivot. It's got room to go lower, at least to 160. Good gap. Oh, look at that 5-minute 3-bar play. Textbook pattern. Entry's pretty clear cut. Entry stop target. Ask yourself, what are we doing? When you're not trading something this obvious, what are we doing? We're decreasing our odds, right? That's what we're actually doing. We're decreasing our odds when we take something that's less than good, less than great. And this is a great example of that, okay? All right, now, some of you, if you've taken professional trading strategies, you've probably seen this. I've used it before. I think it's a good one, which is why I'm using it again. The lower time frame pattern, which is where we tend to get caught up, right? We tend to, I don't know, get excited maybe, get enamored, and put our own spin on something. So let's take a look here, this lower time frame. This is a 2-minute chart, and this is a stock that gapped up. Okay, you can see yesterday's close at 60.50, today's open at like 63.50. You can see the rising 20-period moving average, okay? So we are in this is, to be clear, everything on here is micro. It's micro because it's a 2-minute chart. Right? Everything on here is micro. So you see this gap up, see a little tug of war going on here, doji bar, green bar, doji bar, red bar, buyers and sellers are fighting it out. Okay? And it looks somewhat bullish, right? It does. It's a gap up, bottoming tails. It starts to move higher over 64, it moves into 65, pulls back, moves up, pulls back, moves up, but then that happens, right? You start saying to yourself, okay, this stock has been a little bit tired, a little bit extended because it gapped up and moved higher. Went from 62.50 to 65. It needs a break. So far, we're good. There's nothing terribly wrong here, okay? It needs a resting period. Chops around, tries to put in a new high right here at just after 10 o'clock. And it fails. So far, not the end of the world. Maybe it's just going to consolidate out more and it's going to rest. We don't know yet. We just don't know, okay? But up until this 10 a.m. point, we're bullish. We're bullish because the stock is strong. It was far from the moving average, and it's now resting back towards it, right? We have two types of corrections, a correction through price and a correction through time. This is clearly a time correction, okay? We see the stock try to push higher. It fails to do so, but again, not the end of the world. Maybe it just needs more time. Still above the rising moving average. Maybe it just needs more time. Then what happens? It breaks below this support area right here. 64.25 right there. It breaks below that area. Not a good look for the stock. It breaks below the rising moving average. Not a good look for the stock. Then continues lower. It's getting deeper and deeper and deeper. We talk about level and depth of penetration, right? Bounces, still below the moving average, rolls over and fails. Now we're starting to really question this stock. This is right where somebody in the chat room would inevitably go, Jared, should we buy this right here? Right here, right there. And I would say, no, we need more confirmation. That's an aggressive buy setup because you're buying into a double top under the moving average. Stay away. And then it engulfs and goes lower. Now all of a sudden our opinion's completely changed. We continue to stay below the moving average. We have now put in a lower high and a lower low and another lower low. This is lower low number 1, lower low number 2 because it broke the low of the day from the open. Then we bounce back up and put in lower high number 2. So this is lower high number 1. This is lower high number 2. This is lower low number 1. This is lower low number 2. What are we getting very, very close to doing here? What's happening here? I'll give you a hint. There's a question mark on here. What are we getting very, very close to becoming? What are we getting very close to becoming? Anyone? We're definitely doing that, PS. Right? We're definitely transitioning. Okay. What do you mean stage 1? What? What? Where did that come from? Where did that come from? Okay. Guys, we are transitioning here, right? The transition is between the 3 and the 4. Note, the micro stage 4 has a question mark after it. It's not saying we're in a stage 4. It's saying, hey guys, what's happening here? Well, we need 2 or more lower highs and lower lows to officially be in a downtrend. So, is this officially the downtrend? Yes or no? Right where my cursor is, right here. See my cursor? Right across from where it says good trade, question mark. Are we officially in a downtrend here? Are we? Guys, what confirms a pivot? What confirms a pivot? Take your time, think about it. I mean, does a tiny little topping tail confirm a pivot? What confirms a pivot? If you are trail stopping using pivots, thank you, Jason. Someone is paying attention. You need to make another low or at least test the prior low. It doesn't necessarily have to put in a lower low, at least test it. Okay? Either make a new low or test the previous low. This is not technically a lower high yet. I mean, the next bar could be green and just go higher, right? It hasn't confirmed the pivot, is what I'm getting at. So this is why there's a question mark here. So we are close to a stage 4 downtrend, but we're not quite there yet. We have one lower high, one lower low. We have our second lower low, and we are working on our second lower low, our lower high. Sorry, we're working on this. It hasn't actually happened yet, because if this just kind of goes right here and goes back up, my point is if you were pivot trail stopping, you would not lower your stop loss yet on this. You would not do it because it hasn't consolidated or confirmed the pivot. You would still keep your pivot up here if you were trail stopping lower. I'm not saying you would be in it, but my point is for those of you that use pivot trail stops, you wouldn't lower your stop yet. So the point here, guys, is we're not in a stage 4 yet, but we are damn close. We're really close. So if you look at an entry right here and a stop loss right here, you are in a transition between a stage 3 and a stage 4, but much closer to a stage 4 than the stage 3. So could you, yes or no, could you justify this as a 2-minute micro time frame sell setup? Yes or no? Could you justify this? See where it says entry and stop? Could you make a reasonable justification to short this? Yes or no? Only 2 people are confident enough? The answer is yes, but it depends, right? You could, right? You really could. But you really should be waiting for the stage 4 to confirm, right? That's the truth. You really should be waiting for the stage 4 to confirm. However, let's be clear here. This is an area, right? This is an area where you could get caught up in this chart. Let's explain here. This is what I mean by there. This is an area, okay? You're in a stock that is clearly showing weakness. That's not up for debate. It's clearly showing weakness. It has put in a lower high and a lower low and another lower low. What do we also have? We also have a 50% retracement. We also have declining moving average. Okay, We also have minor price resistance to the left. We have all three location items. We have a topping tail. We have a narrow body bar and a narrow range bar. I mean, if you're doing your checklist, you're checking off some serious stuff right now. All three location items, minor price resistance, declining moving average, 50% retracement, topping tail, narrow body bar, narrow range bar. Oh my goodness. So if you're a new trader, you're starting to feel like, man, the balance is shifting towards I should take this, right? Make sense? The balance is starting to shift towards, yes, I should take it. You may not make every check mark here, like the stage 4 downtrend, which is a big one. But to a newer trader, or a trader who's been struggling, or a trader who's been under duress, or who's not on top of their game, you're looking at this and going, looks pretty good. I'm going to take it. Oh, I'm with you, Jordan. I am completely with you. But I think we can all appreciate what really happens in the real world. People will look at this chart and they will find a way to justify taking it. And they'll use some pretty good ammunition to justify it, right? It's not just some random thing. They'll use some pretty good excuses to justify it. And many of those excuses will be right. But you should hold off, okay? You should hold off. And let's see the main reason why. Because the higher time frame, I knew I forgot to take this out of here. Hold on, let me delete that. Right, because the higher time frame suggests that you should. This is what that chart looks like on the 15-minute. So let's make this easier for you. Let's put them side by side. Right? This is the higher time frame. This is the 15-minute. This is the 2-minute. And this is what happened. So, if you trade in a vacuum and you only look at lower charts and you fail to look at a higher time frame, 15, 60, daily, this is going to happen to you frequently. Sure, you'll get lucky sometimes where you short this and the higher time frame might be in a downtrend. You just get lucky. But why would you want to rely on luck when it only takes about 2 seconds to look at the higher time frame? So when you're looking at your trades, every time frame should be on your chart, right? Or should be on your monitor. So there isn't, oh, I didn't see it. Well, what do you mean you didn't see it? It should be right in front of you. So when you're scanning and you're getting ready to take a trade, why isn't the 60, 15, 5-minute, 2-minute, 1-minute, why aren't they all right in front of you to begin with? Take the excuses off the table. This is a good buy setup on the 15-minute. It's at least a decent buy setup on the 15-minute. Okay? The 2-minute failed, right? The 2-minute failed sell setup confirmed the 15-minute buy setup. So the failure of this sell setup right here is actually the trigger of the buy setup. So looking at the higher time frame 15-minute chart keeps us out of a potentially bad sell setup, right? I forgot to do it again over here. Okay? It keeps us out of a potentially bad sell setup. And trust me, there are plenty of traders that will look at this 2-minute chart on a micro, not look at the higher time frame and go, Jared, it's in a downtrend. And they'll explain it out. They'll send, trust, I get a lot of emails. They'll send me an email and they'll tell me everything that's right about it. Oh, it's got all the location items, it's got the topping tail, it's below the moving average, it's got a narrow body bar, it's in a downtrend, blah, 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 blah. All because they didn't have a higher time frame. This is the forest from the trees. You're in the trees. This is the forest. You're in the trees. This is the forest. Take a look at the forest, man. Otherwise, you're going to give up money. Whatever your risk is, $10, $1,000, $10,000. You're just giving it up because you were too lazy to look at a different time frame. And it'll keep you from missing out on another pattern, which is the 15-minute buy setup. Because the failure of this sell setup on the 2-minute confirms the 15-minute buy setup, which makes the 15-minute buy setup even better. Right? Makes it even better. And sure, obviously look at the market too. That goes without saying, right? Because a rising tide lifts all boats and a low tide sinks all the boats, right? So my point though is you should be looking at this 2-minute in conjunction with the 15. And whenever this 2-minute sell setup fails, your eyes should be getting juicy. They should be watering up going, this 15-minute sell setup looks really, really, really good. Okay? Now I want you to think about something as well. One step deeper. Guys, I haven't asked this question of you in a while. But on a 15-minute buy setup, how often would a 2-minute chart be in a downtrend? On a 15-minute buy setup, how often will a 2-minute chart be in a micro downtrend? Remember, we have micro, macro. It's right out of Professional Trading Strategies. Micro trends and macro trends. So 2-minute chart. How frequently will a 2-minute chart be in a micro downtrend? You guys are like, you really don't know. I can see it by the lack of answers. Let me ask you a different question. How many 2-minute bars makes up one 15-minute bar? How many 2-minute bars makes up one 15-minute bar? How many? 7.5. How many bars, lower highs and lower lows, do you need to make a buy setup on a 15-minute chart or any chart? How many lower highs and lower lows do you need? What's the textbook say? Usually 3, right? Well, that's 3 bars. 3 bars is 22.5 2-minute bars. Okay? 3 red bars, which is what you would likely get on a sequential pullback on a 15-minute chart, right? You're likely going to get 3 bars on that pullback, right? Because we're going to include the bar here, right? You're going to have a lower high here, a lower high here, and a lower high here, right? So you're going to have anywhere from 15 to 23 bars. 15 to 23 2-minute bars. And they're going to likely be red because the 15 minutes pulling back. So the answer is always. Sure, you could probably find an exception, but generally speaking, the answer is always. Always. The 2-minute chart is almost always going to be in a downtrend if there's a 15-minute buy setup that triggers. Now remember, micro downtrend. We have micro trends inside of macro trends. Okay? So make sure you're always looking at the higher and lower time frames, because the picture you see on one is not always the picture you see on the other. And one can confirm the other. In this case, the failure of the sell setup confirms the buy setup over here. It's a very powerful statement. It's a super powerful statement and should hopefully keep you out of a lot of trouble and make your trades better on the higher time frame. This is a double dipper. This keeps you out of taking a terrible 2-minute sell setup and also helps you get into a better 15-minute buy setup that has a double bottom retest at support. Wide range green bar. I don't like when they pull back into these green bars, but it is a double bottom retest and it is at support. Okay? Now, one last slide. You know what? I'm going to end it there today. I was going to do one more slide, but you know what? I think I'm going to end it there today. All right? So, I hope from that, and I apologize one thing. There was one more slide that I wanted to put in and I couldn't find it in time. There's one more example of a very similar scenario of the one I just showed you, and I couldn't find it. I threw this together in like 30 minutes, and If I find it, we'll go over it again in the future. But there's a very similar scenario to the one we just reviewed. I wanted to put 2 or 3 in, but I couldn't find them. Just too many file folders. But anyway, I hope that you guys, even though today was a little bit shorter than normal, I hope that you guys can appreciate 2 things. One, don't take the charts for granted. All right? Don't get caught up. So what I'm trying to say is, look at the forest from the trees and look at the trees. Don't do one or the other. Do both. All right? And recognize and appreciate that both charts are helping you. And when you get them into the alignment, that's when you're going to have the best trades. And sometimes the failure of a lower time frame will actually increase the odds of a higher time frame play. All right? So I guess what I'm saying is basically don't be lazy. Take the higher and lower time frame. Always look at them and never take them for granted. Okay? Because it will keep you out of trouble and help confirm better entries on higher time frames as well. And this works in conjunction. It works both ways. All right? So I hope that will help you guys be more profitable traders, more accurate traders. So I'm Jared Wesley of Live Traders. We'll get back at it again next week.